The world's most dominant currency is being quietly displaced, and Washington is waking up too late. There are no tanks, no missiles, just lines of code. China has rolled out a financial tool the US can't block, sanction, or even trace. The digital yuan is no longer conceptual, it's in full operation. A new international hub has just gone live in Shanghai. 6 leading foreign banks have already signed on. American exporters are beginning to bypass the dollar in trade settlements. While Beijing shapes the future, Washington is mired in dysfunction. Trump is pushing for emergency rate cuts. The Fed is trapped between inflation and stagnation, and $1.2 trillion in interest payments is on the verge of hitting the U.S. economy like a bomb. This isn't speculation, it's the opening act of a global financial showdown. And America's $2 trillion deficit is about to flood into a market that's no longer interested in dollars. So what happens when global demand dries up, but the U.S. keeps printing? Once the ultimate safe haven in crises, the dollar is now faltering. Normally, geopolitical tensions drive investors to U.S. assets, but since Trump's return to the White House in January 2025, the dollar has dropped over 10% against other major currencies. The ICE dollar index fell below 99 in May, a 2-year low. Oil prices have surged past $93 per barrel, typically a boost for the dollar. But this time, investors are bailing. They're not buying greenbacks, they're offloading them. Why? Confidence is deteriorating. Washington's fiscal path is erratic. Debt ceiling debates are political standoffs. Sanctions have been used so heavily they're losing effect. Global markets are beginning to doubt whether the U.S. can responsibly maintain reserve currency status. The dollar's failure to rally during conflict isn't an anomaly. It's the first sign of a deeper realignment. And things are about to get worse. In trying to reduce the trade deficit, Washington is unintentionally worsening the dollar shortage. Reducing imports also reduces the flow of dollars the world depends on to buy U.S. assets. Reuters reports that America's current account deficit shrank to just $28.4 billion in Q1 2025, down from $245.6 billion a year prior. That might sound like improvement, but the dollars that would have circulated globally are missing. They're not returning to purchase treasuries. They're vanishing, and with them, foreign demand. Bond markets are showing serious warning signs. A recent $40 billion treasury sale saw a 22% drop in indirect foreign bids. Japan and Saudi Arabia are stepping back. Some buyers are shortening maturities. Others are walking away altogether. The global distribution network for the dollar is drying up, and China is poised to step in. At June's Luji Izui Forum, China made its play. PBOC Governor Pan Gong issued a clear declaration. The era of one-currency dominance is ending. With full state support, Beijing is pushing the digital yuan globally, launching a cross-border payments hub in Shanghai and integrating top-tier international banks like Standard Bank and First Abu Dhabi Bank into its system. The yuan has risen 1.1% this quarter and now facilitates around 30% of China's total trade. But China's goal isn't merely to displace the dollar. It's to establish a new monetary order where no single country can wield money as a weapon. Their strategy? Convertibility of capital accounts, yuan-denominated futures, and broader reliance on the IMF's SDR basket. China isn't trying to crash the dollar. It's aiming to render it obsolete. That's the real threat. Because this moment wasn't supposed to arrive, not yet. Even China's most optimistic forecasts didn't expect the yuan to gain ground this fast before 2030. But something shifted. U.S. fiscal mismanagement, capital flight, and global exhaustion with American hegemony have all accelerated the timetable. According to Bloomberg Economics, the dollar's share of global reserves has fallen from 59% in 2021 to just 51.7% now. The erosion is no longer gradual, it's picking up pace. And the U.S. isn't leading this transformation, it's lagging behind. The rest of the world isn't waiting. By May 2025, the dollar had dropped to its lowest level of global dominance in 25 years, a historic reversal shaking the foundations of global finance. Meanwhile, the euro and digital yuan are gaining momentum, thanks to revamped systems that simplify cross-border transactions and promote currency alternatives. Christine Lagarde's unusually public visit to Beijing, where she endorsed the idea of a global euro moment, underscored how real this multipolar shift has become. This isn't hypothetical anymore. It's a deliberate international move to reduce dependency on the dollar. Even American multinational exporters, once reliant on dollar-only deals, are now signing dual currency contracts to hedge against growing exchange rate risks. What began as a slow trend toward diversification has now become a rapid, live transition. And it's the speed of this change that might prove most destabilizing. At the same time, the Federal Reserve's June 2025 economic projections paint a textbook case of stagflation, slowing growth and persistent inflation. The Fed has downgraded 2025 GDP growth to 1.4%, down from 1.7% earlier this year. Core inflation is now expected to rise to 3.1%, a 0.3 percentage point increase. Meanwhile, unemployment is forecast to hit 4.5%. The Fed held rates steady between 4.25% and 4.5%, citing high uncertainty as Chair Jerome Powell resists political pressure to pivot toward easing. Former President Trump has intensified his rhetoric, calling for rate cuts of at least 250 basis points to spur economic growth. Yet despite the political pressure, Treasury yields remain high, and interest payments on U.S. debt are projected to exceed $1.2 trillion this year, surpassing even the nation's defense budget. Fed Chair Jerome Powell is responding to clear economic signals. Consumer spending is waning, with retail sales declining 0.9% in May, and new housing starts falling to their lowest point in 5 years. The Federal Reserve is caught in a dilemma. Cutting rates risks reigniting inflation, while holding steady could worsen a looming recession. This policy gridlock is steadily undermining global confidence in the dollar, ensnaring it in a trap largely of its own creation. Meanwhile, China has been quietly constructing an alternative financial infrastructure, engineered specifically to bypass Western sanctions and U.S.-controlled systems. At the June 2025 Lijiazui Forum, People's Bank of China Governor Pan Gong unveiled the launch of a new digital yuan international operations center in Shanghai. This hub is designed to accelerate cross-border settlements using China's eCNY, both within Asia and globally. According to Reuters, 6 major international banks, including Standard Bank and First Abu Dhabi Bank, have already signed onto China's cross-border interbank payment system, CIPS. This platform facilitates instant yuan-denominated transactions without relying on the SWIFT network, which has historically been under Western control and subject to geopolitical influence. Pan directly criticized traditional cross-border financial systems for being too easily politicized, clearly signaling Beijing's strategy to weave the digital yuan into the arteries of global commerce, thereby weakening the impact of U.S. sanctions. Bond markets are watching closely as China also considers launching yuan-based futures contracts, a clear counter to dollar-index derivatives. Morgan Stanley analysts describe this move as the most significant push toward yuan internationalization since the currency's inclusion in the IMF special drawing rights basket back in 2016. But there's a deeper shift underway, one that has gone largely unnoticed. If CIPS transaction volumes overtake SWIFT across Asia's key trade corridors, the dollar won't just lose power, it could become invisible. Exporters aren't waiting for politics to catch up, they're already rewriting the rules. Bloomberg reports that over 30% of China's cross-border trade is now settled in yuan, a record high. Meanwhile, insiders at a major U.S. bank say American firms are adjusting behind the scenes, offering dual currency contracts to partners across Asia to deal with rising exchange rate volatility. In April 2025, 6 BRICS-aligned economies announced efforts to standardize commodity pricing outside the dollar framework, citing increasing unpredictability in U.S. fiscal decisions. Around the same time, Russia and the UAE finalized a multi-billion-dollar oil deal priced in yuan, fully bypassing the traditional petrodollar mechanism. Even leading U.S. corporations are shifting strategy. During its most recent earnings call, Caterpillar revealed an expansion of foreign exchange swap programs in local currencies to hedge against dollar volatility, particularly in emerging markets. The IMF's April bulletin confirmed that global reserves held in dollars have now slipped below 52%, a level not seen since 1999. This is no longer about ideology, it's about strategy. Every trade settled in yuan unravels another strand of America's financial dominance. Trump may advocate for a weaker dollar to support exports, but his administration still relies on a strong dollar to finance a record-breaking $2 trillion budget shortfall, about 7.3% of U.S. GDP, per Treasury estimates in May 2025. Simultaneously, the administration is escalating tariff threats against Iran, China, and the EU, moves that add upward pressure on prices and reduce the Fed's ability to maneuver. Meanwhile, China's economy continues to outperform. Second quarter GDP growth was revised up to 5.4%, with exports rising 1.1% year-over-year despite global headwinds. Chinese state-owned enterprises are increasingly issuing bonds denominated in yuan to foreign investors, effectively laying the groundwork for a truly multipolar financial system. This currency conflict is more than symbolic. It exposes deep structural differences. The U.S. relies on cheap debt and global trust to keep its economic engine running, yet current policy choices are undermining both. In contrast, Beijing is playing a long game, leveraging central planning, stable growth, and expanding de-Americanized settlement network to attract global capital. This isn't equilibrium. It's a countdown, one where only one system will hold. On one side is an American economy staggering under $37 trillion in national debt, rampant political instability, and a global currency that is too critical to fail but increasingly too volatile to depend on. On the other is the rising yuan, digitized, centralized, and underpinned by long-term strategy, not slogans. The debate is no longer whether the global currency landscape will shift, it's who will be sidelined when it does. The consequences won't be limited to government ledgers. They will reshape how your mortgage is priced, whether your job is secure, what your retirement is worth, and how your nation competes in the world. So before you scroll past, ask yourself, if you had to choose today, which system would you trust with your savings? Let us know below, because the next move isn't coming. It's already underway.